a stock market crash in your mind, Jermal?
Well, obviously, well, let me say this. I think the generic idea of a crash is usually when markets are going down, right? And I would say people can vary their ideas of a crash based on the velocity and the time period. Now, if we have a crash of like 5% within let's just call it, like, to be crazy, a 1 day period, which is kind of like the flash crash that we saw in May of 2010, that's an example of a crash. If we have like 20% in like a 2 day period, I'm sure people would be like, oh my God, it's crashing, which for sure they would. So I think it really depends on velocity and time. Did I just have acceleration? I guess I did in a way.
Yeah, no, acceleration and physics aside, I do think you're on the right track there. And that's a great way to think about these things. I think a lot of people get caught up in like, what's a stock market crash? Well, let me ask the Wall Street Journal and like the reporters. And it's like, you can kind of define the thing for yourself. And I love how you worked backwards. Like the simplest thing of like, stock market crash, going to be downside action. Although I want to end today on what we're seeing in the market today, which is almost a crash upward, but usually going to think of it as a movement lower. And then also, like you say, a function of velocity and time. Because if the market moves lower by 5% in 6 months, no one's batting an eye, because that it could have moved lower by, a tenth of a percentage point every single day, and it wouldn't have felt like anything. But 5% in a couple of hours, now we're getting somewhere there. And so I like that you kind of just teamed this idea of short period of time, high velocity, downside action. I want to take it a step further today and put some math behind it and then see what we can do with these crashes, what you've been able to do with this crash of the last week. If you are calling this a crash, would you call this a crash? What we saw in kind of the lead up to the Thanksgiving holiday here in the U.S. and shortly after, a lot of downside action, not only in stocks, but crude oil and a bunch of other markets. I mean, would you define this as a crash here?
No, I wouldn't define this as a crash. I would say this is, the easiest word in the world escapes my brain right now, but just kind of a sell-off.
Yeah, I would tend to agree with you that it's a healthy crash, if it is one at all. It's just like it's a little bit of some action lower. Now, if what we saw was a couple of big days lower 2 weeks ago and last week, Jermal, and then we saw this week maybe like one of those 3, 4, 5% days lower on top of that, then we would maybe be like, all right, this is a full-on crash. But I agree with you. It's kind of like teetering back and forth. And you see that the news items one day are calling for, crude oil's going back to zero and all these different things that are happening. And then the next day it's like, actually, everything is totally fine. And so it is a matter of like fast velocity, short time period, but like some sustained action in a sense of like seeing a couple of these data points. And I think a good way to start putting data behind what it means to be a stock market crash is using something that you and I use every day in our trading, but applying it in a different way. Now, I look at standard deviations constantly for futures trading, and I know you do for options trading, and a lot of other people do for every trading of all kinds, for like day-to-day action, when a market moves outside of a standard deviation on any given day, looking for opportunity. But you can also use these data points to kind of define what it means to be a market crash, because there's a rarity factor to a market crash in that it's like, if the market moves lower by 1%, and that's kind of within the one standard deviation there, kind of like what's to be expected, then you're not really in crash territory. But once we get to 2 standard deviations or 3, even stuff that's occurring between 1 and 5% of the time, that rarity factor also kind of kicks into a stock market crash, right?
Yeah, I would say it does. And I think the interesting thing about more recently is that we saw pretty good movement in both directions, which I think amplified the VIX for the most part, right? Like we saw, I don't know, it was today might be like number 8, like times that the market, well, let's just say SPY in general moved over 1% in either direction, S&P 500.
And I'm glad that you bring that up because there is a clustering effect to volatility in the midst of, and we kind of talked down the idea that we're in a stock market crash right now. I mean, if tomorrow we do see that 4 or 5% down day in S&Ps or what have you, then it is kind of like, oh man, we might be in a little bit of a crash here. So we'll see. Jury's still out on where we are here, but we are at least seeing symptoms of a crash, which is clustering of volatility, big moves in the market. Like you say, Jermal, in both directions. I was only counting the fact that we've seen two standard deviation falls in the small stocks market. Twice we saw this in the last 7 trading days. This is something that should only occur 5% of the time in general. So 2 out of 7, a lot higher percentage than 5% there. And this is just to speak to that idea of clustering. When it rains, it seems to pour a lot of times in stock market activity. And thus, we're seeing even today a 2 standard deviation move in this market in the opposite direction. And it's that clustering effect of volatile big moves that, I mean, you've seen, this happens maybe once or twice every year, right? The clustering of big moves.
Yeah, for sure. And definitely happened last year. I can't remember. I want to say November of last year is the last time we saw something like this, at least this many. Yeah, it does. And you're absolutely right on that clustering thing. I mean, it's totally the situation. Once you see volatility tends to happen in packs.
And this is why, we spend a lot of time talking about volatility, talking about day trading, talking about options, talking about futures is for moments like this, because, when it rains, it pours in these markets. And that's when you see those big IV prints. And, we talk about, selling options when implied volatility is high, and you look at a chart of VIX or any volatility for any market, and you'll see those high prints once or twice a year, and they tend to be focused around, that once or twice per year, and the rest of the time they're low there. And so it is this idea of when we are in a little bit of a crash mode or on the precipice of a potential crash, that's when you have to let those mechanics kind of get you into the market there. Because, I mean, look at all of the trading. The stock market for almost all of summer and fall is relatively boring. I mean, I know I wasn't trading stocks very often, but as of 2 weeks ago, leading up until this morning even, I'm trading stocks more than any other market. And it's because we are in this high volatility, little bit of crash mode. It's this idea that I always get back to, whether you're, a passive investor who's just looking to buy things, an options trader who's looking to sell options, or a futures trader who's just looking for day trade opportunities. When the market gets fearful, that's when you need to get greedy a lot of times, because that's when the action is. And unfortunately, in a couple of weeks or a couple of months from now, stocks are going to get boring again. That's the nature of volatility. And you're going to be looking back at this period being like, man, I should have jumped on more opportunities. I mean, I have to imagine you're trading stocks, or at least you're using a bigger bulk of your account now more than you were 6 months ago, right?
Yeah, no question. And you make a great point. The idea of being mechanical during this time period. I mean, I can tell you countless times throughout the years where we'd have moves like this. And quite honestly, you got to think about, like we just said, there's been at least 7 or 8 plus or minus 1% days in the market more recently. And usually those times I would probably get in and get big or bigger prior to, a lot of the big moves that we had over the last couple of days. I would have probably been in and bigger earlier and probably suffered as a result, versus I would say, it's not BS. It's true. Like the things that I've learned coming here, as far as things that I've been aware of my entire career, but I didn't always practice, being aware of sizing. And so the idea of staying mechanical and keeping your sizing small, so that it helps you with these opportunities. Because, I mean, nobody knows. Nobody can predict. I mean, if you'd have told me there have been like 8 different moves like this over the last couple of weeks, like 2 weeks, since Thanksgiving, basically, since Thanksgiving Friday, I mean, who would have known? right?
That's exactly right. And I'm glad that you bring up that sizing, because I wasn't really thinking about that part of this, but it falls really well in line with the statistics I want to end on here, and then maybe pop up the platform to take a look at what's going on today and how I would treat it, as we are still in the midst of, I know, a big bounce back in almost every asset class, but we still, the fact that we're up 2 to 3% in a lot of equity indices doesn't make me feel good necessarily. Like, it's bullishness, but it's high velocity bullishness that makes me think like, man, that like there's going to be some big moves further down the line. So we'll pop open the platform here in a second. But your sizing piece is exactly right, because you and I, in our younger trading days, would probably tend to, especially, don't tell my former boss, but especially when I was at a prop shop and I wasn't trading my money per se, but other people's money, you would tend to be like, oh, we're getting a big day finally. Like, it's been slow for months. We've got a big day, full boat. I'm going all in on this stuff. But now, having patience and just having more markets, like, I mean, interest rates have been absolutely amazing the last couple of months. Metals have been a good trade, and crude oil, a lot of back and forth. Having those other markets to keep you involved outside of stocks, so that when stocks come in, you have a little bit of patience, is huge. And I bring up the results of the stock market here after 1 standard deviation down days, 2 standard deviations, and then 3 standard deviations. And keep in mind that those 1, 2, and 3 standard deviations, they just vary in their rarity. We tend to see a 1 standard deviation move in the stock market about 32% of the time. 2 standard deviations, we only see about 5% of the time. 3, we see less than 1% of the time. And you can see that if you bought the stock market on any of those 3 standard deviations, you're up the next day on average. Now, if you buy a little bit on 1 standard deviation days, buy a little bit more, you size up a little bit on those 2 standard deviation days, and then when you get that really rare crash move in the stock market of 3 standard deviations, that's when you're preserving, a lot of your size to go like, I'm going to get large now. The 1 or 2 or 3 days a year when we see this, you're seeing great success rates when, I mean, it's in the last couple of years, this is from 2018 till now. Of course, we've only seen a handful of 3 standard deviation moves, but market is positive the next day 100% of the time. And I always, that's a caveat. It's probably only 8 to 10 data points in there out of the last 3 or so years of trading. But I mean, you can't knock the statistics on this. You size up with those bigger moves. You tend to see these reversals after the crash multi-standard deviation moves. I mean, these numbers kind of jiving with what you would have thought.
Yeah, I mean, absolutely. And it just speaks to that idea of sizing. I think it's a tough process sometimes. You think when you see not only maybe the 1, but definitely when you see the 2 standard deviation, you're like, okay, now I'm going all in big. Or even when you don't, the times that you don't, and the market does rebound, you're like, I should have went in big. And so I think it just kind of helps protect you from yourself.
Absolutely. That's what all mechanics are for, is keeping you and your emotions out of what the data is presenting as opportunity here. Because, I mean, a lot of people are going to kick themselves. Oh, I should have bought more and everything else. Or what's much worse than that is, oh, I got in too early. And so hopefully this talks a little bit of that down here and just helps with that sizing and reducing the emotions like we always try to do in our trading. And now I want to pop open this platform and take a look at what we're seeing here. Because I mean, we saw the multi-standard deviation sell-offs in this market of last week and the week before, and now we've bounced back off of those like the data has shown. But now we're seeing a multi-standard deviation move to the upside in small stocks market, up 3%, NASDAQ up 3% as well, Russell up a little bit under that 3% number. And to me, it is that idea of like, man, we don't see 3% moves in either direction in equities very often. But I'm ready to jump on these opportunities. And this was how I traded at the board of trade, where it's like I was, trading primarily future spreads, but it's the same idea where it's like when the stuff would get out to 1 standard deviation, these spreads, it's like, all right, I'm putting, this size on. When it gets out to 2 or gets out to 3, then I'm putting on a little bit of an escalating size structure. And now at 2 standard deviations in SM75, definitely an intriguing short, in the same way that buying down those 2 standard deviation moves were an intriguing long and would have paid you. What say you?
So this is I got to ask, so this is your standard view. You like looking at what is that? 15-minute, 2-month?
Yeah, most of the time for my day trading, this is what I'm tending to look at is the 15-minute charts. It gets me the last, obviously the last 24 hours in movement, but a little bit of context for where the market's been. And you can see here that, we've sold off and bounced back a fair amount. And now we're bouncing back to those highs in such a fast fashion that I think this is ripe for a little bit of a reversal. I'm in actually a little early into this market around 83. And if it gets closer to 84, I'm probably out for a loser on today's day trade. But this is that idea of like when it was up $1.25, a little bit of size. And then when it gets up 2 standard deviations, which in this market is about $2, man, that's a really intriguing opportunity. And if it gets up to $3, that's something that we see maybe once per year. And I'm kind of leaning against that, right? That's why I'm leaning against that rare move not happening. But if it does happen, then I, can hopefully come through with another little tranche of size potentially. But what say you about the stock market today? I mean, does this seem like too much too soon? Because it does for me.
Yeah, I mean, it's definitely a rising tide raises all ships thing.
Sure.
What it shows you, and to get small, little macro, it shows you that there's serious fear, right, revolving around any of the variants that we get. And so seems like as that fear is kind of removed a little bit, I mean, it's still early, right? Like it's really only been like 2 weeks when this thing kind of the news of it kind of really came out of South Africa. So there's still a lot we don't know, but God, I mean, like I said, it's raising all ships. Yeah, I was about to say all tides, all ships right now, right? As opposed to, and then of course volatility is tumbling right now. I'm not exactly sure where VIX is. I think from VIX is like a 22 or something like that, somewhere around there. Actual, index is 21. So it seems a little. It seems a little much for the time period. Is it overdone? I wouldn't say it's overdone. I mean, we're rising. We're right back to where we were right before Thanksgiving. We're literally right at that level. So, take that for what it is.
And it is. I'm glad that you bring that ship analogy into this, because a point that I do want to make is that when it rains, it pours in stocks and it pours in other asset classes that become more correlated to stocks. And so just keep in mind, I'm looking at the SM75 here, or if you're used to trading Russell, stick to Russell or NASDAQ or whatever, this isn't a scenario where it's like, oh, multi-standard deviation moves in all of these markets, I'm going to get short all of them, because you're putting on, keep in mind that you don't want to put on the same trade a bunch of times, because I've been battling with myself, like, do I want to trade crude or stocks on any given day? And you have to make that decision for yourself. And yeah, by the way, this is the January crude. If you're trading December crude in smalls, make sure you roll to the next month. So that's why we got the weird data there. But just make sure that you're not doubling up, like, oh, I'm short crude and I'm short an equity market, and they're both highly correlated. I'm either going to win on both or I'm going to lose on both here. But yeah, I think there's an opportunity to be had in a lot of these crashes, both lower and higher in the equity market. We'll see what happens.
We will see what happens. It's an interesting day. This is a big move.
Yeah, all I can hope for, like, and this is the way this stuff goes. Like, worst case scenario, get short the stock market here, and the market moves through my upside loss marker, and I get out, and we just kind of grind back to those highs, and it's like, oh, the fun is over. But best case scenario is like you get that nice day trade scalp here in stocks, and then maybe tomorrow we get another big leg lower. We just want the fun to continue. We want that volatility to continue.
I would agree with you. Yeah. I mean, this has been good action. I've actually enjoyed the idea of different action as opposed to just down, 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 down. Right. This has been good.
Absolutely. Yeah, and I guess that's a good place to put a bow on the conversation around crashes. Is that like, thank you very much, resident Santa Claus there, putting bows
I'm
on
terrible at
things.
rapping, by the way, just FYI.
But it's the idea that in the equity market, at least, when you see a market crash, it doesn't tend to be down, 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 down. Like, of course, the market does trend lower, whether you're looking at, the .com crash, or you're looking at the financial crisis of the '07, '08, and '09. Of course, yeah, the market lost a lot of percentage points, but it's a matter of like 5% lower, 0.5% higher, or 1% higher, or 2% higher, and then another big leg lower. And so that is a nice thing about stock market crashes, however you define them. They don't tend to be just single direction for weeks at a time. There's a lot of bouncing back and forth. So maybe we're seeing that. We still jury's still out on whether we're in the midst of a crash. We'll find out next time on Small Stakes. Jermal, thanks so much for joining me as always, and don't forget to follow Jermal on Twitter and also catch his wonderful program.
Thanks, buddy. I appreciate that. They'll see.
Do you want to plug the program?
Engineering the Trade, 1:30 Central, 2:30 Eastern. I'll see you guys a little later on, man. Join me.
Awesome stuff. Thanks so much for joining us. I'm about to join Pete Momat. Splash into Futures is coming up next. Everybody hang out for that, and thanks for watching. Peace.